Awesome. Thanks, Stacy. Thanks, everyone. I really appreciate the time today to join IDC's University Day. You know, I've talked to a couple of my colleagues who have handled the IDC account in the past, and they rave about IDC University Day as one of their best memories. So look forward to many of these in person as we move forward. So today we're going to be talking about some innovative solutions to help your business take flight. That's really what we focus on here at BMO Insurance. So we're going to be diving into the whole life strategy and some solutions for you. Again, there's my contact information there. I have talked with many of you on the call and look forward to hearing from others who I haven't connected with yet. I look after BMO Insurance in all of Ontario for IDC. And then I do have some other colleagues that look after IDC all around Canada. So we'll dive right into it. Just to quickly go over the agenda for my portion today. We are going to be highlighting BMO Insurance's whole life value proposition. I'm sure some of you have seen this information before, but really going to emphasize the three pillars and strength of our product. Then we're going to be spending some time talking about the recent enhancements we've made to our additional payment option with the ability to increase those APO limits with adding term riders to the base coverage. And then lastly, we'll be just touching on the APO flexibility and some recent changes we've made to that as well. So I'll be speaking for about 30 minutes today. Then we're going to hop over to Rose, and she has some exciting information to share with you on our seg funds. So if you have any questions throughout the presentation, just pop it into the chat. I'll save a couple minutes before we hop over to the seg fund side to go over any questions you have. So diving into our value proposition. So really what we're focused on with our product is the transparency and simplicity of it. So when we designed our product, those were two areas of focus. On the left-hand side here, you can see our crediting formula. So our performance bonus is our version of a dividend. Our performance bonus rate is announced in May of every year. So our performance bonus is a very simple formula. And again, the transparency and simplicity is the focus here. So the guaranteed cash value in the contract, plus any additional payment balance that was included with the payments, multiplied by the performance bonus rate. So our performance bonus rate is announced May every year, as I mentioned, and it's the only variable in the contract. The rest is guaranteed. So we're comparing that to some of our competitors, a traditional participating whole life, for example. There are a lot of moving parts and a lot of variables, right? So I know I'm no mathematician, but if your client were ever to ask about the formula for a dividend, I know I wouldn't be able to explain that. So really the focus of our product is eliminating some of the moving parts and the simplicity to it. Moving on to our second value proposition, really what we're trying to focus on with our product is reduce the volatility as much as possible. And reducing that volatility equals an improved client experience, right? So what we're showing on the screen here is BMO, the estate protector product at a 5.75% performance bonus rate. And then if it drops 25 basis points to 5.5%, and we're comparing that to one of our competitors on that same 25 basis point drop, right? So when we're looking at the values here, we're looking at a much lower spread. So I know what all the advisors I work with, I encourage them to stress test their solutions, run at a -2 or -1 scenario. You never know what these performance bonus rates or dividend rates are going to look like. I know we think it's safe to run it at a current performance bonus rate or dividend rate, but those things could change, right? They're not necessarily guaranteed. Those are variables to take into consideration with your contract. So when you're servicing your client, say if you have those annual meetings, the meetings are a lot easier, obviously, when they match the original illustration you sold them, right? So if, for example, the performance bonus rate drops 25 basis points, we see a much lower spread in the values than, say, some of our competitors, right? So it kind of speaks to how we can accomplish a much lower volatility with our investment strategy. And I'll touch on that briefly as I move forward through the presentation, but I encourage, if any of you want to learn more about our investment strategy, I'd be happy to book some individual time to go over that with you. So moving on to our third value prop, the guarantees. We tried to load our product full of guarantees. As I mentioned, the only moving part is the investment experience. The rest is guaranteed. So mortality, lapses, expenses are all guaranteed in our contract. versus some of our competitors, you're participating in the highs and lows of those variables, right? So all the investment mortality, lapses, expenses, they all factor in to that dividend rate being announced. With us, it's only the investment experience, right? And on top of that, we have 3 different guaranteed payment periods, our 10 pay, 20 pay, and life pay. We have higher guaranteed death benefits and that guaranteed bonus formula that I mentioned. So again, just to recap, what you see is what you get. The transparency of our product, the guarantees, and the reduced volatility are the 3 pillars that our product stands on. So since the investment experience is really the only variable in our contract, it makes sense to touch on that here briefly. So just to quickly touch base on our investment strategy, as I mentioned, if any of you want to dive deeper into this, please reach out to me individually. I'd love to have a discussion with you on it. But how we accomplish our 5.5% performance bonus rate, we are investing in long-term corporate bonds and fixed income, and then we're using the yields gained from those fixed income or those long-term corporate bonds to participate in the enhanced equity market, buying call options in the low vol indices in North America, in Canada, and the US. And then we have a smoothing formula to get our performance bonus rate. So just a bit of a recap, our overall investment strategy has continued to provide that downside protection and reduce the volatility, as I mentioned earlier. It is supported by those fixed income returns. The returns on the low vol indices the past year trailed the general market a little bit, but still contributed favorably to that performance bonus rate. So our smoothing formula does continue to help minimize that volatility on the performance bonus rate. But we did just announce this week that our performance bonus rate will be maintaining a 5.5% return, and that is guaranteed to April 30th of 2023. So important to highlight that. Just goes to the stability and the strength of our product that we're maintaining that. And this screen here just kind of gives you an idea of the stability we were able to keep, right? So when we launched in 2017, it was at 5.5%. We were able to go up 25 basis points for a couple of years there, and we have maintained the 5.5% rating. So that kind of sets the stage. We'll dive into the product now and just kind of go over some different scenarios here with you. So our estate protector, we have 2 different versions of our whole life product. We have our estate protector, which is obviously focused on the back end, the estate. And then we have our wealth accelerator, which is more focused on those high early cash values. So we're looking at our different options here. This example provides a cumulative amount of $250,000 total deposit over the specific pay periods, right? So our 10 pay is still our flagship product. It provides those best long-term values from a death benefit perspective, but also on a cash value perspective as well. So with our death benefit here, what we're looking at, we're comparing our 10 pay, 20 pay, and life pay, right? So the payments are spread out to still equal the total of $250,000. And as you can see, our 10 pay is really shining. We're getting as much money as possible into that contract early on a guaranteed payment basis, and then the values continue to grow. So for comparison's sake, let's say we use our 20 pay and life pay structures with max APO, and then you're using offset at year 11. So you're still mimicking a 10 pay, but of course, on a life pay or 20 pay basis, it's not necessarily guaranteed. The 10 pay is still shining, right? From an overall death benefit perspective. If we're looking at life expectancy, a male age 40, looking towards year 40 to 45, still looking the best here, right? And then just looking at our 10 pay compared to the competition on the 10 pay, we're really shining compared to a 10 pay basis on this type of product and in this market, right? So still looking great from a cash value perspective and overall death benefit perspective. On the other side of the equation, the wealth accelerator, we're focused on those high early short-term cash values, right? So this was the most recent addition to our portfolio. 2 years ago, we did introduce the wealth accelerator version of our product. We saw the need for higher early cash values from different strategies that are taking place in the market. So we're very competitive at those high early cash values, but it does come at a bit of a sacrifice, right? You're sacrificing the back end growth. BMO is the blue line there, of course. So we're tailing off to some of our competition there in the back end. So it kind of led to a need and discussion of some other areas we wanted to highlight, right? So as I mentioned, our guaranteed payment period the shortest guaranteed payment period is our 10 pay, right? We can get to say a 5-year payment period, but previous to us introducing these term riders, using a life pay with max APO and offset at year 11 was the only solution previously. And of course, when we're doing that, that's great, but there's still a lot of volatility there with offset. Offset's not necessarily guaranteed, right? So we wanted to introduce another scenario which provided some more flexibility there. So this just kind of gives you an idea of what the offering was before, as I mentioned. So we're looking at premium offset in year 6 on a life pay basis. So it's a large offset structure. And then we're looking at the competitors from that same perspective. So on the death benefit, we're not looking as great, to be honest, right? On the back end, we're tailing off a bit. We're looking a little bit more competitive there, but still some area. And again, when we're focusing on our guaranteed 10 pay and our guaranteed products, shortening the guarantees, it didn't look as great on the life pay basis. And then you see the cash value here as well. So we were still able to compete, but it kind of led to us wanting to have some more options, right? So again, as I mentioned, option 3, the life pay was the only option, but now that we've added term riders, we've offered some new possibilities. So on our 10 pay and 20 way, on our 10 pay and 20 pay, I'll show you now how adding a term rider, you can decrease the payment period and have that 5 pay as an option. So just to highlight exactly what we're doing here. So we're adding a term rider. It is only available for single life. We are in the midst of working on some joint life solutions as well, adding the term rider to create more APO room on the joint basis. But when we add the APO option, it does equal more tax deferred room. They can pay off the policy sooner. And for those of you that are on the call, they don't necessarily, if they aren't necessarily familiar with APO, I know some other companies call it the additional payment option or the ECO. There's different terminology for it. But for those of you who are maybe more familiar or comfortable with the UL basis, basically what we're doing, what the APO does is it allows additional deposits to increase the cash value, increase the death benefit, just like a UL if you were to deposit more than just the minimum on that, right? And it keeps it within that tax deferred fund or in the tax deferred cash value, and then just grows the death benefit, right? So we're still keeping it within the MTAR. So adding a term rider is increasing the overall death benefit, giving us more room to dump more money in is really the thought process, right? So with that being said, we can utilize premium offsets sooner because there's more value in the contract. So just kind of take you through here again to highlight what we're doing. So as I mentioned, as the face amount increase, the APO room increases as well, that tax deferred room. And then that APO room would increase even further when we're adding that term rider to increase the overall death benefit, right? So as I mentioned, it is on a single life basis. So they do have to be the same life for the base coverage and the term rider. So that's one of the caveats to keep in mind here. As I mentioned, we are working on joint in the coming months as well. So stay tuned for that. But this is kind of where we're at right now. So this just gives you an example of exactly what we're trying to do here, right? So we're looking at a male age 50 on a guaranteed 20 pay basis for $250,000 on base coverage and $500,000 term rider. So I'll show you as we move through the presentation kind of how you can tailor that and set it up as you wish. But just to take you through here, so at the base premium, $8,600 and change, we have the term rider cost. You see it's a very minimal addition from the minimum premium, right? So we're still at, we're tripling the coverage essentially. We're getting up to overall $750,000 of coverage, but because the term rider is so less expensive, it gives us much more room. So the APO room just on the base coverage is 6,300, but say your client wants more room or more deposit room and they want to shorten that payment period, adding a $500,000 term rider in this case gives them a lot more room to deposit in there on the APO, right? And we're looking at the market with this similar scenario. There are only 2 other competitors that offer these solutions. You can see them there, carrier D and carrier E. With the other carriers, you're really pigeonholed, so to speak, on these types of solutions. So this is our latest introduction here and kind of where we've gone with that. Now I'll show you kind of the target market and a couple of examples here on exactly where you can apply this. So the target market, ages 40 to 65, is where we've really seen this shine. Important to note, there has to be a need for permanent and term insurance, right? From an underwriting perspective, the need still has to be there for both. So please make sure you can justify that and your client has a need. And I'll show you an example of that coming up. And then it really is applicable when your client wants to shorten the premium payment period, right? So they want to go on a guaranteed 10-pay basis, shrink that all the way down to a 5-year, and you're doing the 5-year with a 10-year, so you're decreasing the offset period, right? If you're doing it on a life pay, you have a much larger offset period, and who knows what could happen because the offset's not guaranteed, right? And then, of course, it's applicable if your client's looking for a different asset class, and this could fit well there. So let's look at an example. If you have a client that has that $250,000, as we were speaking on earlier, they want to invest and they want to do a 5-pay. Well, the questions come to mind: is it better to do a term rider? What's our best option from a BMO Insurance perspective? And how are we looking on the marketplace, right? So we'll take a look with our 10-pay here and show you exactly what we're looking at. So we're using our Estate Protector 10-pay, our Wealth Accelerator 10-pay with term rider, and then our Estate Protector without a term rider, right? So that's $25,000 in payments over 10 years on that dotted blue line. You see it's still coming up short there. If we were to add a term rider to it, we're shortening the payment period, but we're able to put more money in quicker, right? Because we're increasing that APO period, or that APO room. So we're going down to 5 payments of 50,000, and we can really see the cash value shine towards life expectancy there, which is why we're using our Estate Protector product, right? So with the wealth product, obviously we got those higher early cash values, but we're tailing off on the back end. And then from a death benefit perspective, similar story. We're not competitive there with our Wealth Accelerator. Without adding the term rider, we're not accomplishing what the client wants. They have to do 10 payments. And of course, they're guaranteed 10 payments, but they only wanted 5. So we're guaranteeing it to be paid up in 10 years. But when we add the term rider, we're able to shorten it to 5 payments. And then you have that limited offset period. So let's just see the best of the competition and kind of how we look there. So looking at Carrier D, the green bar here, they've taken a similar structure, 10-pay, and then added a term rider. And then they're doing offset at year 6. So only 5 payments there as well. And still with our Estate Protector, we're still shining there from the cash value perspective towards life expectancy. And then the same thing on death benefit perspective, right? So we're looking good in this particular scenario. I wanted to show you that on a different graph, right? Now we're looking at more the numerical values. It kind of breaks it down a little bit more simpler for you. So when we're looking at the winning solution, right, the one that looked best in all scenarios, we meet the objective of the 5 payments. With those total deposits of $250,000, we're still buying them the most amount of face as well. So we're doing a 1-to-1 spread here. So with our illustration software, I encourage you to reach out to myself. We can kind of play around with some solutions you have. You can use our solve feature, solve for the face amount for what they want to put in based on the premium deposits, and then add a term rider and kind of play around with it to get the best solution. So we're buying the largest face from an IRR on total death benefit. The Estate Protector is still looking best at age 85 around life expectancy, but we're not far off here with the term rider, right? When we're comparing to our wealth or the competition, we're not looking as great. IRR on total cash surrender value is still looking the best on just the Estate Protector as well. But again, you need 10 payments, but still looking pretty good there from the Estate Protector, that winning solution. From an FYC perspective, our Wealth Accelerator does pay the best there, but still looking pretty competitive with that winning solution from the values and death benefit, which is most beneficial to the client. Now, I want to take you in just lastly here with a real life case study. This is a case that we won. This client scenario fit perfectly to this new solution that we've offered. So I'll quickly show you that. So we have Alfonso. Alfonso just moved. He has $250,000 outstanding on his mortgage balance. His mortgage will be paid off in 10 years. So again, thinking as an advisor, I'm thinking, okay, $250,000 on his mortgage. There's a need for term. Term 10 would fit there. He has that need, checks that box, right? He has the permanent insurance need for estate planning, expected tax liability at age 85 for that $450,000. He wants to invest in a tax efficient asset class, and he wants to pay up his policy as quickly as possible. And he has $150,000 available for his coverage. So let me show you exactly how we would structure the solution and how we won this case. So total annual premium, we know we can get to that 5-year marker. So we divide the payments from 150 by 5, gives us that 30,000. We're satisfying his mortgage need, right? The $250,000 in coverage. And then we're bringing up the base coverage, solving that for the remaining portion. So we're buying 215,000, 975,000 of initial coverage. Again, he has the $450,000 need on the back end. So we're starting out with this, but then look at all the APO room that's created by this, right? So we've created an additional 15,500 and change for APO room for him to deposit in for us able to get to the 5-pay marker, right? So you see how big of a difference it makes putting on that term rider. And again, this is a solution that won, and we're quite proud of this one and where we fit into the marketplace here. And just from a competition standpoint, the other best solution, Carrier D, that we were talking about, who also provides a similar solution, we won in all circumstances here. So again, similar to the last example, we're buying a higher overall total face amount. We're doing a little bit more than a 1-to-1 spread for the term rider. The IRR is looking best on our product. We're still paying the best from an FYC perspective. Total death benefit at age 85, we check off that box of 450,000, even after the term rider has fallen off, right? And then IRR on total death benefit is still looking strong there as well. So, and then you see it on the graph form here. The blue bar is really shining there with the total death benefit and cash values there as well. So quickly, just to recap, by adding that term rider, you have the ability to increase that APO room, available on both our products for any premium option. Any of our riders are available. We have a plethora of term options available, whether they're standalone term or a rider on our whole life. As I mentioned, it has to be single life only. In-force policies with the term rider, they now can make those APO payments after their next policy anniversary date. So those of you that have existing whole life clients, they'll be seeing that on their statement. They have that increased APO room that they can make as well. And then as of fall of last year, now our in-force illustration software can provide those as well. So just a few tips when you are playing around with this and trying to fit the best solution. Again, I encourage you to reach out to myself. Happy to run some solutions for you, but you're always evaluating the client's objective, permanent versus term insurance, whether the need is for short-term or long-term cash values, makes you choose which version of our product you want. If there is need to access those cash values, keeping in mind the IRR is always important when you're comparing to an alternative investment, right? Really shows that this is the solution for them. As I mentioned earlier, start with the 1-to-1 ratio. So say, for example, $250,000 of base, $250,000 of the rider. If it fits, sure. But then I normally would go to a 1-to-2, so double it, and then so on. You can just keep going and see if it provides the amount of APO room you're looking for. With our Wealth Accelerator, you might need more of a term rider on that to accomplish what you need. Term 10 has seemed to be the optimal values there, even though you can use those other term solutions. Term 10 provides a great solution there, and then the term coverage is intended to drop off after that term duration, right? So you do have the ability to adjust those amounts of insurance and payments if necessary. We do offer the flexibility, but again, 5-pay is as low as we can get to with the premium offset feature. Last thing I wanted to mention, this was also brought out towards the end of 2021 with our most recent introduction. Our APO payments, our flexibility has continued to increase. So now the client can make those APO payments after the payment period, right? So once the policy is paid up, say if they have a 10-pay or 20-pay, and they still want to utilize that APO feature, they can still dump in the max APO annually every year. and they can stop and start it whenever they want without underwriting. So we're the most flexible on the marketplace with that. If your client has one of those solutions, or you're selling a 10 pay or 20 pay, make sure you're letting them know, look, even though we're trying to pay this up as quickly as possible on a guaranteed basis, you still have the ability to deposit more as you go throughout the policy. So very important to know that. I know I've worked with a lot of advisors, including some IDC advisors, who love that solution. It's been a great sales opportunity with their clients, and been really effective there. So that concludes my portion of the presentation. Again, please reach out. I'd love to hear from you guys and help build the best solutions for your client. That's my contact information on the screen there. I'll make sure to follow up with everyone in attendance today, but hope you enjoyed that and found some use in those solutions.
Hello, everyone. Thank you so much for joining us today. My name is Rose Nguyen. I'm the Segregated Fund Specialist covering Western Canada for BMO Insurance. And today I am going to be speaking on a few live cases to be closed, some sales ideas as well to share with you, and hopefully give you some ideas where you can utilize in your practice. Before I get started, I wanted to show you a couple of contact information. So again, my contact information, or if you're in Western Canada and you wanted to connect with someone on the BMO GIF side, that would be myself or your local BMO GAM wholesaler team, which you may be familiar with if you are dual licensed. They cover the ETFs, mutual funds, as well as the segregated funds. And of course, we have Carolyn Young, my counterpart in Quebec. She covers Quebec and the Atlantic provinces. Her contact information is there. And of course, she is also supported by the BMO GAM team that you may be familiar with. And you can reach out to any of us for any questions or case consultations. So my session today really focused on preserving, protecting, and growing your practice, as well as your clients' assets under management. But before I get started on that, I wanted to just focus on one thing here that you may not be aware of. We do have partners at the BMO Bank side, which is our BMO Lending and Mortgage Specialist Group. We do have a program in place if you're looking to really put that fence around your current clients. Perhaps you are offering them insurance as well as investments, but now you can also offer them the ability to also look at BMO as a home for their mortgage. And the one thing I would say about this program before going quickly onto the next session is that in order to be part of this program and offer your clients a referral to the BMO Home Financing Program, you need to be contracted with BMO Insurance as an advisor. And also there is a 32 basis points that is directly paid to the agent for this referral. So depending on what type of mortgage that you're referring. And then the other thing that is really important to note is that we do have a non-solicitation rule that prevents the BMO Bank from really cross-selling any life insurance or investment products to your clients that you refer to the bank. Of course, if the client already is an actual client of the bank, then they are also a client. But I think if you are referring to a client that has never had a product with the bank and it's through this referral program, there will be a notation on the account ensuring that there is no cross-selling. So I just wanted to make a note of that. So this really dives in really well with my next topic, which really is growing your business and growing your clients' assets. So that referral program will help you not only put your arms around the products that you can sell your clients, including a mortgage with BMO, but also being able to grow your practice as well. So let's take a look at some ideas on how to grow your business organically. So 3 quick tips on growing your business. One is to really deepen those relationships that you currently have. For every single client that you have on your book, do you have their TFSA, their non-registered account, their RDSPs, RESPs, RRSPs, etc.? And if you do, then do you have their spouses or their other family members, their children, right? So it's really important to really look at your book of business and try to deepen those relationships, connect with the next generation, whether it's their children or their parents, and offer them some wealth transfer strategies that I will be focusing on in the next few sessions as well. So what I wanted to mention here is that we do have some great materials, and as I'm going through the session, you'll see some of these materials that have come up. Two really great pieces that we have is the estate planning fact finder for individuals and business owners. We have this in PDF as well as in hard format. And of course, the investor profile questionnaires. These are great materials to help you with estate planning discussions. It really dives deep into, who their support network is, their accountants, their lawyers, but also who are their beneficiaries, who are they going to be helping with estate planning, and who they are as an executor, whether it's to their aunts and uncles or parents' estate. And this will help you really dive deeper in the discussions and possibly have a network of people that you may not have reached out to before for your services. Now, I think it's really important when you're speaking with clients that they understand the probate process that applies to their jurisdiction, whether it's Alberta, Manitoba, or BC, or even Ontario, right? So having that discussion and explaining to them what happens when they pass away and the legacy that they leave their family. So we have this really great piece here. It's client friendly and is applicable to each province. So if you are interested in getting this piece to share with your clients in your discussions when you're talking about estate planning, investment planning, legacy planning, please feel free to reach out to myself or Carolyn. We'd be happy to share that with you. Now, why segregated funds? For those who have not utilized this product in your book of business, I think it's important to just highlight the key reasons why you would consider looking at BMO GIFs or segregated funds in general. BMO GIFs unlock a value for clients definitely looking to preserve their wealth. There's assured outcome through guarantees. Of course, you got the bypass probate and other fees, timely payments. It can be private depending on how it's structured and depending on which province you're in. And of course, creditor protection is also a feature that is attractive to employers or not employers, but business owners as well. What I wanted to highlight is the timely payments. I had an advisor challenge me to timely payments. He asked me to take a quick look at some of the accounts recently where I've seen where there was a death of the annuitant and the contract closed, and how long it took BMO to send out these payments. And at first I was like, okay, that should be interesting. We talk about 10 to 14 business days when we receive full paperwork, death certificate, signing off, everything. And we want to make sure that we actually pay in with that amount of time. So in the last 3 death claims I've seen over the last 3 months that I was directly involved in, where the MGA reached out to me or the advisor, when I checked, the first case was paid out within 8 business days. The second case was paid out in 10 business days. And the third case was paid out in 14 business days. Now, is it from the beginning to end that it was that short? No, of course, by the time the advisor provides us with the date of death and getting all the beneficiaries to sign up all the forms, that can take several months because depending on where the beneficiaries are and getting the correct information back and forth, I think that's important. But the moment that we got all documentations that were in good order, we paid within the time that we had said that we would. So I think that's important, and not a lot of clients or advisors are aware that we do have a great process there. So I wanted to highlight that quickly. So when it comes to segregated funds, we have 3 target markets. We have the 75-75. They tend to be for clients who are wealth accumulators who do not need the guarantees, looking for a lower MER, possibly higher equity exposure. So what we do offer in that is the 75-75. Of course, our 100-100, which I will highlight a little bit more, is our flagship contract. And the reason for that it is quite unique in the industry. We do offer an automatic monthly reset of the maturity guarantee very unique in the industry. And it's typically for clients who are more conservative, clients who are in the pre-retirees, and really looking to protect those assets until maturity, right? So I'll go over a few cases where we had positioned the 100-100, but again, very unique in the industry. The 75-100 is what we call the estate series, and this is where the majority of our fund flows go into. We have, I would say, about 60 to 65% of our fund flows going into the 75-100, or more recently, the 75-100 plus is a contract really earmarked for older clients and deposits getting 100% death benefit before the client's 85th birthday on those deposits. And I think it's quite interesting because I'll share a case where we've seen a lot of people selling their homes and downsizing or going to retirement homes, and they're looking for a place to put those funds, and we're seeing that in our 75-100 plus. Now, what's most important is recognizing where segregated funds can be used. And if you're looking to grow your book of business, especially in this space, I encourage you to take a look at these 3 projects and do a deep dive into your book of business and ask yourself, do you have clients who are between ages 65 to 90 who have estate planning needs? Now, if you have a list of those clients, you could definitely start the conversation with those clients. Now, if your clientele is younger than that, possibly what you might want to look is at clients between 45 or even 40 to 60 years old. They're likely going to be an executor on their parents' will or a beneficiary. And you want to have those conversations with these clients because they will be a great referrer to their parents or grandparents. And of course, for those very conservative clients who want guarantees on their investments, segregated funds, especially our 100-100, would be an interesting product or tool that you can use to have those conversations with clients as well. Now, I'll move on to protecting your clients' retirement assets, but also protecting your own book of business by offering some of these options for your clients as well. So I just want to make sure that I'm good in time. We are good. And let's go over a case. So we're taking a look at the grandparents. So we have Charles's parents who are snowbirds. Michael, who's 82, and Claire, who is 80 years old. They mainly invest in GICs and cash, and they're also terrified of the markets. They're not happy with the low interest rates, and they want to leave a legacy behind to their kids. So when we look at their children, they have 3 children. They have Charles, Julia, as well as Christian. And we know that they saw a close friend who passed away 3 years ago with no will, and their estate was just finally settled today. So they want to make sure that the funds that they have, that they will distribute quickly and according to their wishes. Another wrench here is that we know that Christian, one of the sons, is the youngest child, but is somewhat irresponsible with money. So what is the solution for them, for these clients? So a simple solution to quickly and privately transfer wealth is really to set up a seg fund contract where you can name the children directly as beneficiary on a non-registered account. With that, you do also have the option of adding an annuity settlement option, which provides an installment of income for Christian through an annuity. As well, on our 75-100 plus option, we do provide a 100% death benefit guarantee on deposits made before age 85. There is an automatic triennial death benefit reset up to age 80 of the death benefit guarantee. And of course, the clients have access to our prestige class pricing as long as they meet the minimum of $250,000. And they do have access to some of our best-in-class ETF portfolios and funds available on the lineup. So now, just to recap, on our lineup, we do have the 75-100, which I'd mentioned earlier, and it does provide 100% death benefit on deposits made before age 80. Now, by adding this additional contract, the 75-100 plus, it really accommodates for this particular client situation where they're older than 80 and they're looking for that floor, that 100% capital preservation on death, and they're looking to ensure that 100%, at minimum 100%, will be going to their beneficiaries. And they do have a number of years where they can still add to the contract before they hit age 85. So there are some 4 ETF portfolios available in the money market, and it is front end zero. So if you have any questions or you have any clients where this might be a good fit for, feel free to reach out to us. We do have case scenarios. We have a lot of client videos, materials that you can share with clients. Now, I did talk a little bit about the annuity settlement option. It really gives your clients the choice on how to distribute their death benefit. They could, again, provide a lump sum or an installment or a combination of both. So the annuity settlement option allows more flexibility. The clients can cancel, can change, can make any changes that they want. And as long as they are coherent when they are making these decisions, and they can sign, they can, again, make any changes with no cost to them. And they can have peace of mind that the one child, say Christian, will be receiving an installment rather than a lump sum. So he's not going to go to the casino with it. Now, the other thing that I wanted to note is that advisors, if you are on record at the time when this takes place, and you will be involved in setting up this annuity with the beneficiaries, you will be paid again for this piece of business. Okay. So I wanted to just stress on a live case, and I've seen several of these. So this one particular one was for an 83-year-old client out of Victoria. She had sold her house for $1.5 million and setting in and really moving into a retirement home. She wanted the ability to name beneficiaries and keep the assets out of probate. She was looking for full capital protection on death, and she was looking for something better than a GIC. So we know that with this particular case, after speaking with her insurance advisor who had helped her really get things together after her late husband had passed, she decided to open a contract for $75,100 plus. She went into the conservative ETF portfolio with prestige MER of 2.24%. So extremely attractive with a 1% trail. Okay, so lots of live cases. Carolyn and I will be happy to share with you any that we've seen, and some interesting cases that are a little bit different. But with the limited time today, I'll just share some of the more general cases that we've seen. So next, I'll talk a little bit about your GIC clients who are really very conservative and now really, really unhappy with what is out there. I can tell you that my mother called me, I think it was 6 months ago, and she said, Rose, I have money at TD and I'm trying to renew my GIC, and I think they're giving me 20 or 30 basis points. Like, what is that? I'm like, it's a percentage of a percentage. And she was not happy. But I mean, there's lots of cases out there. There's clients who will have GICs at different institutions. What are some of these options? And I'll be happy to share that, what we have here with you. Now, we know that GIC rates have been on the decline, 13.2% since 1980 to 1.95% for a 5-year GIC. Just as inflation, everyone talking about inflation is in the headlines. I've heard recently inflation in Canada hit over 6% or something insane. I'd never thought I'd see that day. I mean, I think we were just so used to really enjoying the low inflation as well. So what does that mean for your end client? 50 years ago, a cup of coffee is 25 cents. Today, it's $1.79. I think that is if you go to probably 7-Eleven. If you're going to a Starbucks, it's probably going to cost you $7 for a double latte with extra everything in the whipped cream. But the idea here is rates are going down, inflation is going up. So what can we offer these clients who are really conservative and looking to protect their funds, but also help grow their money? So here we have Charles and Karen. Charles, again, is the son of Michael and Claire in the last case. We see that Charles is 55. Again, Karen's 54. Charles works in a tech firm in a management position. Karen is a small business owner of a specialty cupcake boutique that's online. They themselves have 2 children. One is 30, married with a child, and then Matt, who's a bachelor. So with Charles and Karen, they're worried about protecting their retirement nest egg. They want to leave a legacy to their kids and their grandkids. They want to invest in the market, but they are frightened of the market. They've seen what's happened. They want to protect and grow their retirement funds. They're worried about market volatility, and they're not happy with GIC rates as well. So what can we look as a solution for them? Now, for Charles and Karen, we could take a look at possibly a BMO GIF 100-100 contract. We stipulate that the contract matures in 15 years when Charles is ready to convert this contract to into a RIF. So we're looking at his RSP assets. What Charles gets from this contract is 5 years of automatic monthly reset features. And what that means is, as the market is increasing and his portfolio is growing, we are locking in those gains for him. And that at the time that he's ready to start withdrawing funds from his RSP, which is converting to a RIF, he can decide what he wants to do at that point in time. But we're protecting these assets and this capital during this accumulation phase. Of course, at 71, when he looks at the contract, he could decide on whether he wants to keep it or if he wants to convert it and change it to a guarantee option, which has a lower guarantee, depending on his needs at that time. Now, did I skip something? I did skip something. So what I wanted to highlight here is a point which I think is quite important. The BMO Balance Etf Portfolio is one of those mandates available on our lineup. And what I wanted to share with you here is what this would look like if someone had invested in a portfolio on January 1st of 2017 to the end of March. What they would have seen is 23 resets that would have taken place over the last 63 months. Okay, so that's where you see the white dot. And of course, we're only going to lock in gains. We're not going to lock in losses at all. So as he's investing, as the client's investing, they're getting an assured outcome. We're guaranteeing that at maturity, they are going to get the highest of one, the market value, or two, the highest reset that's taking place in that contract at that period of time. So what I see here and what you can see here is a very powerful piece that I would encourage you, if you wanted to get a copy, feel free to reach out. I do send this out once every quarter in my email blast as well. We do update this on a quarterly basis. And what this shows here is for your very conservative client, you can show them that as the client's investing, we lock in the gains. And when there's times of market volatility, like January 2020, we see that the portfolio had locked in at 286,000. And of course, when the market drops, and you don't know when that happens, but the conversation is very different for these clients versus someone who is in a product with less guarantees. It goes like this. Mr. and Mrs. Client, I understand that you are very conservative and you're concerned about the market. This is why we decided to really put you into this type of portfolio with these guarantees. It allows you that as you're investing, we're locking in those gains. Even if there's a market pullback, we're ensuring that you retain these gains. And the point as an advisor is to keep the clients invested over the long run. They are not going to achieve their goals if they get scared and hide and sell their assets and wait for a better entry point. The problem with that is you don't know when the market is going to go back up again. You don't know if it's going to go back down. There's no way to really predict the future. But we do know that as clients, if your clients are looking for a better outcome in terms of the investment returns, they would have to look really more over the long term and be invested in the market to potentially get better than what your GICs is offering. Okay, and this type of product will help you have those conversations for your very conservative client. So here we see at the July or so that the markets again in 2020 started to pick up again, and of course then they start locking in those gains. Now, if those clients never had the ability or the stomach to stay in this contract, they would have been out and they would have crystallized those losses. Okay, So I think it's really important that if you haven't had a look at this type of product, to consider it for your very conservative clients for a portion of the portfolio. Here we see it being utilized in a RIF, an RSP account. I've seen this used in a non-registered account for clients ranging from 45 to all the way to age 75. Okay, so I think that's important. Again, to some things, monthly maturity resets occur automatically and up to 10 years before the maturity date. The resets do not actually push out the maturity date. So every time we do a reset, we don't push it out 15 years. Once you select a maturity date for this client, it stays in place. And of course, clients also have the option of having a triennial death benefit reset. It is an additional fee. And of course, they have access to ETFs, our ETF portfolios of some of the mandates we have on the street, as well as prestige class pricing. Now, I'm going to move on to the third section of my presentation. I know I have 7 minutes left. And it's really about preserving your client's assets, but also preserving your book of business as well. So we now look at the other grandparents. So we have Karen's dad. He's a widow, 75 years old. His wife passed away a few years ago and left him with a substantial investment portfolio. Now, Ted would like to leave this money to his only daughter, Karen. He has concerns that Karen's ability to make sound investment decisions. So what he really wants is he wants to have his advisor help Karen with her inheritance that he wishes to leave her. So how do we set this up? Of course, we can use segregated funds. So a solution and a simple way to quickly and privately transfer wealth to Karen is we set this up where Ted is the owner and annuitant of the contract. Okay, so he controls the contract. It's based on his life. We also ensure that we add Karen on as the successor annuitant and successor owner. And of course, the beneficiaries would be the next in line after Karen. This would be the grandkids. So on Ted's death, the contract will remain intact, but Karen becomes a new owner and annuitant. Of course, there's going to be a taxable disposition when the contract is transferred to Karen's name because there is no child and father as a rollover, right? So it is a disposition. So there is taxes to be paid. But what's great for the advisor here is that the advisor retains these assets and builds a new relationship with the next generation. So I'm starting to see a lot of this being set up. So I would encourage you to consider looking at this setup for your own business. If you have clients who are older and they have concerns about their child or children not being able to manage money properly if they were given a lump sum. And it's also great for you to be able to articulate to your client and let them know that you can help them also really take care of these funds, these assets, these inheritance for the next generation. And it will help you preserve not only your wealth, but also preserve their wealth, may I add, but also preserve your book of business as well. And in closing, I mean, this is definitely something to consider. We're seeing more and more advisors use this strategy, and it really is a great way to really bridge that gap. Now, I've had some advisors say to me, well, what happens if the clients decide to leave? Well, if they decide to leave, meaning the beneficiary, they decide to leave, but it gives you that ability to have that conversation and retain those assets as much as possible. It's much harder when these funds leave and actually a check goes to the beneficiary and you're trying to chase after them to come back and to opening an account with you. Okay, so I see that we do have some Q&A and there's a hand raised, but I have a couple more slides and then we can definitely open this up. So when it comes to compensation, we do offer for compensation that you may be familiar with, front and load DSC. I've seen less and less DSC being utilized in the space just because I think advisors and clients are seeing that there's other opportunities. And what we're seeing is more chargeback options used. We do offer a no-load 3 and no-load 5. Both are quite popular. They account for about 60% of our fund flows. Please note that we will waive DSC and no load chargeback on death of the annuitant when there is a death benefit payout. As of day one, I know some of the other carriers have a 90-day or 120-day window. A most popular option, again, I've mentioned, is our no load 3. It is only a 24-month chargeback period. First prestige pricing is at $250,000 based on social insurance number. And the only other thing I want to add here is that we will pay full upfront commission on all funds, including money market, fixed income mandates, balance, as well as equity. So full upfront commission on all funds. So we will not, we leave it to you to make that decision with your clients. We will pay you for the planning that you do. And we will pay full trailers on all funds except money market. So full trailers on income, fixed income, balance, equity, etc., just not on money market. Okay, I am done with my sessions. Zack is there. Do you have any questions? I'm just going to put up our screen here on our MERs. I just want to highlight how cost-effective the fees are. They're really, really attractive. And I'm using the Balance ETF portfolio because it actually garners a lot of our fund flows. So Zack, are there any questions here?
Awesome. Thanks, Rose. Coincidentally enough, one was actually on the MER. The question was, how is the MER calculated? MER minus fund performance?
No, so there's the gross performance that is at the higher level. What your clients see on their statements and in the growth of their funds is already a net, so it's already included in there. Okay, so I think it's important to note that anytime that you see any rate of returns published by BMO Insurance or BMO segregated funds, it is net of fees, meaning it has already been incorporated in there. So if you want to reach out to me, I can give you the formula of how MERs are calculated. There's a few things in there, but I think it's important to note that any returns, it is net of fees. I think there was another question here in terms of RDSP. If a client wanted to open an RDSP account, is this available? And I do not know currently of any providers that offers a RDSP account with segregated funds. And many of you who are dual licensed may be aware that an RDSP account is extremely complicated, and there's a lot of things that have to be considered. And at this point in time, they are not available with segregated funds. However, our BMO GAM team, who covers the ETFs and mutual funds, will have this available on the mutual fund side. So if anyone who's dual licensed is interested, they can reach out. Or if they are working with an advisor with IDC who is mutual fund licensed, maybe connect with them and see if you can share and have joint work and have this other advisor, which is MFDA licensed, provide the RDSP. I just wanted to close this off. Thank you very much, everyone. This is my contact information as well as Carol's information. Of course, you are supported by a huge team of BMO GAM wholesalers who are in your respective region. They have support of the internal wholesalers as well as the ETF specialists, as well as the seg fund specialists. Feel free to reach out to the team. Any one of us can help you in any cases, build any comparison tools, and help you close business. Thank you very much.